The framework presented begins with a clear rejection of price-based targets as a reliable decision-making tool. Rather than focusing on specific dollar levels for silver, the strategy is built around discipline, relative valuation, and consistency. The central idea is that successful exits are not defined by dramatic single decisions, but by structured processes that reduce emotional interference and force actions to occur within predefined conditions. At the core of this approach is the understanding that silver does not move in isolation. Its value is constantly shifting in relation to gold, and that relationship provides more actionable information than absolute price levels. By anchoring decisions to this relationship, the strategy removes the temptation to react to short-term volatility, media narratives, or fear of missing out. The objective is not to predict tops or bottoms, but to respond systematically as conditions evolve. This framework also recognizes that selling should not be treated as a binary event. Exiting a position gradually allows exposure to be reduced without abandoning participation entirely. It introduces flexibility while maintaining control, ensuring that decisions remain aligned with valuation rather than sentiment. In this structure, timing is governed by ratios and predefined thresholds, not headlines or crowd behavior. The result is a strategy designed to preserve gains while remaining adaptable. It prioritizes process over prediction and structure over emotion, setting the foundation for every subsequent decision within the exit plan. The gold to silver ratio serves as the central measurement tool within this strategy, because it evaluates silver in relative terms rather than in isolation. Instead of asking whether silver is expensive or cheap in dollar terms, the ratio answers a more relevant question. How much silver is required to purchase 1 ounce of gold at any given moment? This comparison provides a dynamic framework that adjusts automatically as both metals move through different market phases. When the ratio is elevated, it indicates that silver is undervalued relative to gold. When the ratio compresses, it signals that silver has strengthened in relation to gold and may be approaching levels where trimming exposure becomes rational. This approach avoids the common mistake of anchoring expectations to round price numbers, which often encourages emotional decision-making and delayed action. The ratio does not promise precision, but it offers consistency. The strategy relies on predefined ratio zones rather than a single trigger point. By identifying levels where silver historically becomes less attractive relative to gold, the framework creates objective conditions for action. These conditions do not require forecasting future prices or interpreting complex signals. They only require observing whether the relationship between the two metals has shifted enough to justify a change in positioning. By using the gold to silver ratio as the governing mechanism, the exit process becomes rule-based. Decisions are made because a measurable relationship has changed, not because confidence or fear has increased. This allows the strategy to remain intact even during periods of extreme volatility, reinforcing discipline at moments when it is most difficult to maintain. As the ratio compresses and silver strengthens relative to gold, the strategy shifts from observation to execution through a process of scaling out. Rather than attempting to identify a single optimal exit point, exposure is reduced in measured increments as predefined ratio zones are reached. This method accepts uncertainty as a permanent feature of markets and replaces precision with structure. The first major trim zone is established around a gold to silver ratio near 50. At this level, the framework considers silver to have moved out of deep undervaluation and into a range where risk and reward begin to rebalance. When this condition is met, a partial reduction is executed rather than a full exit. In practice, this initial action represents a meaningful but controlled decrease in exposure, allowing gains to be realized without abandoning the position entirely. Scaling out serves two purposes simultaneously. It locks in progress achieved during favorable conditions while preserving flexibility if the trend continues. If the ratio continues to compress further, additional reductions can be made according to the same logic. If it stabilizes or reverses, remaining exposure is retained without regret, as decisions were made incrementally and according to plan. This approach also limits the psychological pressure associated with all-or-nothing decisions. By distributing actions across multiple stages, the strategy minimizes the emotional burden of timing errors. Each reduction is justified by the same valuation framework, ensuring consistency across all execution points. In this way, scaling out becomes a disciplined response to changing conditions rather than a reaction to market noise. A clear distinction between paper silver and physical silver is essential within this framework, as each serves a different function and carries different priorities. Paper silver, due to its liquidity and ease of execution, is positioned as the first category to be reduced when exit conditions are met. Its role is primarily transactional, making it suitable for systematic trimming without operational constraints. Physical silver, by contrast, occupies a separate position within the strategy. It is treated as the last asset to be sold, not because of expected price performance, but because of its role as a form of insurance against broader systemic risks. This distinction prevents the strategy from conflating liquidity with security. While paper positions are optimized for flexibility, physical holdings are preserved for stability. By selling paper exposure first, the framework ensures that adjustments can be made efficiently and without disrupting long-term protection. Physical silver is not subject to the same timing pressures, allowing it to remain in place even as other positions are actively managed. This hierarchy reduces forced decisions and avoids unnecessary liquidation of assets intended for resilience rather than short-term gains. The separation of these two forms of exposure also reinforces discipline. It prevents the temptation to overtrade physical holdings in response to market movements that are better addressed through liquid instruments. In doing so, the strategy maintains clarity of purpose for each component, aligning execution with function rather than treating all silver exposure as interchangeable. Once silver exposure is reduced according to the predefined framework, the strategy does not transition into inactivity. The objective is rotation, not liquidation. Capital released from trimmed silver positions is not held in cash for extended periods, but instead reallocated into other assets. This approach reflects a commitment to remaining invested rather than attempting to step outside the market entirely. Rotation is guided by the same principle that governs the exit itself: disciplined reallocation based on structure rather than impulse. By moving from silver into alternative assets, the strategy seeks to preserve momentum while adjusting exposure to changing conditions. This prevents gains from stagnating and avoids the erosion of purchasing power that can occur when capital remains idle. The emphasis on rotation also reinforces continuity. Exiting silver does not represent a loss of conviction in tangible assets or long-term positioning, but rather an acknowledgement that relative value shifts over time. By reallocating rather than withdrawing, the strategy remains adaptive without becoming reactive. This process further reduces emotional pressure. Decisions are framed as transitions rather than endings, making them easier to execute consistently. Capital remains productive, exposure remains intentional, and the overall framework continues to operate within defined rules. In this way, rotation becomes an extension of discipline, ensuring that exits serve a broader allocation strategy rather than standing as isolated events. The framework also includes clear conditions under which silver exposure may be increased again in the future. Re-entry is not treated as a reaction to regret or a response to price momentum, but as a valuation-based decision governed by the same comparative logic used for exits. The trigger for renewed accumulation is a widening of the gold to silver ratio, signaling that silver has once again become inexpensive relative to gold. This condition restores symmetry to the strategy. Just as compression of the ratio justifies reducing exposure, expansion justifies rebuilding it. The emphasis remains on relative value rather than market narratives or emotional impulses. Re-entry is therefore framed as a continuation of discipline, not a reversal of conviction or an attempt to recover missed opportunity. By defining re-entry parameters in advance, the strategy avoids one of the most common behavioral errors: chasing assets after they have already appreciated. Instead, it waits for conditions that reflect imbalance in valuation. This patience ensures that capital is redeployed only when the relationship between gold and silver supports it. In this structure, silver is never permanently abandoned nor permanently held. Exposure expands and contracts as conditions dictate, guided by a single consistent framework. The result is a cycle of participation that remains aligned with relative valuation, reinforcing consistency across both exits and entries without reliance on prediction or emotion. The broader environment in which this strategy operates is shaped by a significant shift in global reserve behavior. Central banks across the world are increasingly accumulating gold and, just as importantly, retaining existing holdings. This trend reflects a measurable decline in confidence in the long-term credibility of the US dollar, even as it remains the dominant global currency. The decision to hold gold is not framed as speculation, but as institutional risk management. Gold's role in this context is defined by its neutrality. It is widely recognized, politically unaligned, and universally accepted as a store of value. As geopolitical tensions intensify and financial markets experience heightened uncertainty, central banks have responded by strengthening their gold positions. This behavior signals a preference for assets that do not depend on the stability or policy decisions of any single government. The scale of this accumulation underscores its significance. Gold prices have surged to record levels, reflecting both increased institutional demand and broader concerns about financial stability. These purchases are not concentrated in a single region, but are distributed across countries with varying economic profiles, indicating a shared assessment of risk rather than a localized strategy. Within this landscape, gold is increasingly viewed as an insurance asset. Central banks are not actively trading these holdings, but securing them. The accumulation and retention of gold reserves provide a structural backdrop for understanding why relative valuation between gold and silver matters. As institutions prioritize stability and preservation, The relationship between these metals becomes a critical reference point for disciplined allocation decisions. As central banks reassess their reserve compositions, gold has emerged as the primary alternative to traditional fiat currencies. The shift is not driven by enthusiasm for a new monetary system, but by the absence of viable substitutes with sufficient scale, stability, and global acceptance. Major currencies such as the euro, pound, yen, and yuan lack the combination of neutrality and universality required to function as dependable reserve anchors under current conditions. The dollar's declining share of global reserves reflects structural concerns rather than abrupt abandonment. Erratic policy decisions, mounting public debt, and the increasing use of financial sanctions have introduced uncertainty into long-term reserve planning. While the dollar continues to dominate, its relative position has weakened, prompting institutions to rebalance rather than replace it outright. Gold occupies a unique position within this adjustment. It carries no counterparty risk and does not rely on policy credibility. As confidence in fiat alternatives remains constrained, gold has become the default stabilizing asset within reserve portfolios. This explains why it has surpassed other currencies to become one of the most significant components of global reserves. This institutional behavior reinforces the importance of relative valuation between precious metals. As gold consolidates its role as the primary reserve asset, its relationship with silver gains analytical relevance. The strategy's reliance on comparative measures aligns with the same logic guiding central banks, prioritizing structural resilience over short-term performance signals. Alongside accumulation, central banks are increasingly focused on the physical control of their gold reserves. A growing number of institutions are repatriating bullion previously stored abroad, relocating it to domestic vaults. This movement reflects heightened sensitivity to geopolitical risk and a preference for direct custody in an uncertain global environment. The decision to repatriate is not uniform, but the pattern is consistent. Countries with elevated exposure to geopolitical or financial instability are leading this shift, reinforcing the interpretation of gold as a defensive asset rather than a trading instrument. The act of bringing gold home signals a long-term commitment to preservation and accessibility under all conditions. At the same time, overall central bank gold purchases continue to rise. Annual buying has increased materially, led by nations seeking to strengthen balance sheet resilience. Despite these changes, the United States remains the largest holder of gold reserves, underscoring the metal's enduring role within the global financial system, regardless of currency dynamics. This combination of accumulation and repatriation suggests that gold is being treated as strategic infrastructure rather than a market position. For allocation frameworks centered on precious metals, this behavior provides important context. It highlights why relative valuation, rather than short-term pricing, is the appropriate lens for managing exposure. As institutions prioritize security and control, disciplined frameworks rooted in structural relationships become increasingly relevant. The strategy concludes by emphasizing the role of structure in avoiding the most common errors associated with managing precious metal exposure. Emotional decision-making, fixation on price targets, and excessive leverage are identified as recurring sources of long-term underperformance. These behaviors often emerge during periods of heightened volatility when discipline is most difficult to maintain. By relying on a clearly defined framework, the strategy removes discretion at critical moments. Decisions are not delayed in pursuit of perfect outcomes, nor are they rushed in response to fear or enthusiasm. Each action is justified by predefined conditions, ensuring consistency across different market environments. This approach does not eliminate uncertainty, but it contains its influence. Consistency is presented as the defining factor in long-term wealth preservation. Rather than seeking exceptional outcomes through prediction, the framework prioritizes repeatable processes that can be applied across cycles. This mindset aligns with institutional practices, where risk management and capital allocation are governed by rules rather than sentiment. Ultimately, the framework positions silver exposure as a dynamic allocation rather than a permanent stance. By combining disciplined exits, structured re-entry conditions, and awareness of the broader monetary environment, the strategy reinforces the value of preparation over reaction. In doing so, it offers a model for maintaining control and coherence within an inherently uncertain financial landscape.